Good evening, everyone, and welcome to the April 26th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver-Candy, and I want to thank you so much for joining me this evening. We had a lot of questions come in, so I'm going to breeze through the introduction and then get right into the questions that came from our community. So, a little bit about the agenda. First, I'll give you a brief tidbit about the center itself, then some information specifically about office hours, and then we'll jump into the questions. So about the center, we were founded in 2021 with the vision that all college and career school students in Maryland have the chance to be creditworthy, ready, resilient, empowered, successful, thriving. And we want to make that happen for them. So we're going about achieving this vision by helping them build their financial life skills and empowering them to thrive. And if this sounds like a cause that you're interested in supporting, I encourage you to visit us online at mccfw.org and then click on the support tab to see how you can join us on this journey. As for office hours is our free semi-monthly virtual student debt clinic that provides borrowers with a trusted venue to help them navigate their student loans and prepare for financial success beyond repayment. Before I get into the questions, I just want to issue a disclaimer that office hours is presented for informational purposes only and should not be construed as financial or legal advice. I answer the questions as accurately and with as much consideration as I can, but your situation is truly personal. So you need to take information in from sources like this, as well as your lender, servicer, and pair that information with a good look at where you are financially before you make any decisions about your student loan repayment strategy. So with all of that out of the way, let's get into the questions from the community. The first one is about consolidation, and specifically consolidation concerning the IDR account adjustment. Question is, I heard about the IDR account adjustment, but I've heard some bad things about consolidating as far as interest rates and taking longer to pay off. Is it really worth it? This is an excellent question. I can't tell you how many times I've had people say to me, especially in recent months, that they did not consolidate because they were told that the interest rate was going to skyrocket or the repayment term was going to be really, really lengthy. And so they held on to older loans. And many times holding on to those older loans means not being eligible for as many benefits. So let's talk about consolidation and what actually changes. I want to zoom in on the key terms involved in lending. The first one is the interest rate. And this is, I'm telling you, this is the most common issue that I hear that keeps people from consolidating. They're afraid that the interest rate is going to explode. But truthfully, when it comes to federal student loans, the interest rate on your consolidation loan will begin with a weighted average of the interest rates on the existing individual loans. So if you had 5 loans and the range of interest rates on those loans was say 4% to 7%, then the weighted average would be somewhere between 4 and 7%. The loans that have the largest balances, the interest rate attached to that large balance loan would have the most influence on the weighted average, but the overall interest rate is going to be somewhere in between the lowest rate loan and the highest rate loan. The only time that you might see the interest rate increase, and this is the weighted average could increase, is due to a rounding convention. And that's that the Department of Education uses a rounding convention that takes that weighted average and rounds it up to the next highest 1/8 of a percentage point. So that's 0.125, 1/8 of a percentage point. So if the interest rate does rise, it's not going to rise significantly. So remember that. The interest rate on a consolidation loan has to do with your existing interest rates and will be calculated using a weighted average, and that weighted average will be rounded up to the next highest 1/8 percentage point. The second key term to focus on is the length of the repayment term. When you use the application to consolidate, it's strictly through studentaid.gov. And as you walk through the application, you'll notice that you come to a place where there are repayment estimates. And there are balance-driven repayment plan estimates as well as income-driven repayment plan estimates. With all of those estimates, you're going to see repayment terms that assume that you have not made any payments already. So the range of repayment terms that you'll usually see is from 10 years or 120 months to 25 years or 300 months. And for people who have been in repayment for a long time already, when they see another 300 months, that's kind of frightening because they're thinking, I've already paid for 10 or 15 years and now I've got to pay for another 300 months. Is this right? If this is true, I don't want to do this. But just keep in mind, the consolidation application does not incorporate any of your prior repayment history into its estimates. It assumes that you are starting from scratch, and that since you're starting from scratch, you have an entirely new repayment term ahead of you, with usually a minimum length of 10 years or a maximum of 25 years. Once your prior repayment history has been reviewed, that can help push you closer to cancellation by way of income-driven repayment or even public service loan forgiveness. But just know that when you're completing the consolidation application, you're not going to see that prior history. You're going to see things as if you're starting fresh with a new loan going forward. Next is the repayment plans. Within the application, you can see estimates for both balance-driven and income-driven repayment plans. But the income-driven repayment plan estimates are based on the information that you provide in the application. They'll ask you for your state of residence. They'll ask you for your adjusted gross income, as well as the number of people in your household. And then some detailed questions will follow about the other people in your household, whether they're dependent children or other dependents. But with the basic information, the estimate of your adjusted gross income, your family size, your state of residence, they'll provide you with estimates for the income-driven repayment plans. After you go through those estimates and select a plan, you get to another page that actually asks you for permission to go to the IRS and transfer information from your tax transcript over into the consolidation application, so that more accurate information can be provided to you later about your options under the income-driven repayment plans. So it's kind of difficult to see exactly what repayment will look like within the application unless you have your exact adjusted gross income from your most recent taxes. If you put in any other number, then you might, you're going to come up with estimates from that repayment estimator that aren't necessarily what will happen when you enter repayment. Repayment will be based on the actual information, either from your tax transcript or from you submitting alternative documentation of your income. Lastly, a key term that you want to look at is provisions for cancellation. The two major programs that we've been talking about in recent editions are income-driven repayment and public service loan forgiveness. For certain types of loans, those commercially managed loans, they are not eligible for PSLF or to get credit through the IDR account adjustment. So if you want to be considered for those particular programs and you have commercially managed loans, you would have to consolidate them to get them into the pipeline for evaluation for those programs. So in terms of like, should you consolidate or not, that's a very personal decision. But do not let the reason that persuades you against consolidation be that, oh, the interest rate is going to explode, because that's not the case. Or that, you're going to have to pay for another 25 years if you've been paying for 5, 10, or 15 years already. That's not necessarily the case. The application just doesn't reflect that history. So the decision to consolidate, it's a personal one. Going through the application can be a bit intimidating sometimes, especially for people who are married and the spouse has income but might not have student loans. There are several layers to this decision. But if you want to be considered for cancellation by way of the IDR adjustment, or you want to get your loans on track for public service loan forgiveness, and you have commercially held loans, you would have to consolidate to make sure that your loans are considered for both of those programs. Now, in terms of what consolidation looks like for an actual borrower with commercially held loans, I want to give you this from someone that I know. And I've used this example before because it's a perfect example of the difference that consolidation can make during this special period till the end of this year, December 31st of 2023. So this particular borrower has a commercially held FFELP consolidation loan that was originated in 2006. The principal balance on that loan is $14,500. The outstanding balance is $11,110. Before I go any further, I just have to make sure that everyone sees the principal and the outstanding balance. This loan is from 2006. That's 17 years ago. The principal was $14,500. 17 years later, this person has been paying on time in full as promised for 17 years. The outstanding balance on this loan is still $11,110. So if this person were to keep on the current track, their monthly payment right now is set at $73. The repayment term on the loan is 248 months. The expected payoff date for this loan is 2042. So we're looking at another 19 years. We have 17 years done already. We've got about another 19 years to go. That would mean it takes 36 years for this person to pay off a $14,500 loan. Now, with the adjustment, this adjustment is the income-driven repayment account adjustment. So in order for future payments to count toward IDR cancellation, this person would have to consolidate the loan into the direct loan program and enroll in an income-driven repayment plan. This would get them on track for their history to be evaluated, but it would also set them up for their future payments to keep on counting toward IDR cancellation. So with the adjustment, looking at the income-driven repayment plan, this particular example assumes that the borrower would have a $50,000 adjusted gross income with no dependents. And if that's the case, their lowest income-driven repayment option available is $136 per month. And that comes from the loan simulator at studentaid.gov. Now, because this would be a new consolidation loan, the application is going to show them a repayment term of another 240 months. So this is looking forward 20 years and assuming that if this person keeps on paying as promised on an income-driven repayment plan, that they would pay the loan off in 20 years from now, so 2043. Now, the expected payoff that you'll see there, I've noted, is 2026. That's a lot earlier than 2043 or even 2042. This is because we know, or I know, that this person had undergraduate loans. And with undergraduate loans, the term for cancellation through income-driven repayment, at least through this adjustment, is 20 years if the person had not been enrolled in an income-driven repayment plan. So after this person consolidates into the direct loan program, they'll receive a payment count in 2024. That payment count will reflect all of their repayment history back to 2006. And taking a look at this loan, it's a consolidation loan. So that means that there were other loans prior to this loan being consolidated. So the history will be examined back to 2006 on the consolidation loan, but then history will be examined for the repayment status on the individual loans that went into the consolidation loan. Now, I don't know what year those individual loans were taken out, but I know it had to be prior to 2006 because that's when the consolidation loan was dispersed. So this person has perhaps at least 20 years of history already. By consolidating into the direct loan program, they get this commercially held FFELP consolidation loan into the pipeline for consideration through the IDR account adjustment. And if it turns out that they have more than 20 years of that qualifying repayment history, then this loan could be canceled right after they'd have to consolidate first, and then after the payment counts are issued for the IDR account adjustment. Now, there's some language from the Department of Education that says some people will begin to see cancellation automatically, depending on their loan types, the repayment plan they were enrolled in, and how long they've been in repayment. For this particular borrower, the loan is currently commercially held. So they would not be included in the group of people that would get a payment count. But after they consolidate this loan into the direct loan program, they would expect to see a payment count in 2024. And we definitely would shave years, lots of years, off of the expected payoff. We definitely pay it off before 2042 or 2043. But the only way to cut that expected payoff date down would be for this person to consolidate the loan into the direct loan program. Also, if this person works for a qualifying employer in the realm of public service, it's possible that that if they submit the PSLF application, the debt could be forgiven by way of public service loan forgiveness too. But again, that cannot happen until those commercially held FFELP loans have been consolidated into the direct loan program, okay? So I just wanted to show you all an example from a real life borrower of the difference that this IDR account adjustment could make. All right, a little bit more about IDR, because when I explain this to people, a lot of people just did not know that income-driven repayment plans actually include cancellation, but it depends on the kind of loans that you have and the repayment plan that you've been enrolled in. So generally speaking, income-driven repayment plans offer cancellation after either 20 or 25 years of repayment. And here's a breakdown of where that 20 or 25-year figure comes from. So for income-based repayment, when you're looking at the loan simulator or at the estimates within the consolidation application, you might see IBR for new borrowers and then regular IBR. For a new borrower, the term is 20 years. So that after they've been in repayment for 20 years, the remaining balance of that debt is supposed to be canceled. I don't want to call them old borrowers, but for people who are other than new borrowers, that term was 25 years. I keep saying this every edition, I need to go back and verify what the newness means. I think it's associated with borrowing after July 1st of 2014. And I promise next edition, I will have that verified for you. But for people who are classified as new, it's 20 years. For people who are not new, the period is 25 years. All right, next we'll move to income contingent repayment. Income contingent repayment offers cancellation of the remaining balance after the borrower has been in repayment for 25 years. Most people aren't really familiar with income contingent repayment, but Parent Plus loan borrowers probably are, because income contingent repayment is the only income-driven repayment plan that's available to borrowers who have Parent Plus loans. If you have loans for your own education and loans for your child and you consolidate those loans, then the income contingent repayment plan will be the only income-driven plan you can enroll in. Now, then we have pay-as-you-earn and revised pay-as-you-earn. With pay-as-you-earn, cancellation is offered on the remaining balance after repayment for 20 years, regardless of whether the loans are undergraduate loans or graduate professional school loans. But with revised pay-as-you-earn, that makes a difference. If all undergraduate loans are included in the plan, then the period for cancellation is 20 years. But if there are any graduate or professional school loans included in the group of loans that are being paid under revised pay-as-you-earn, then that cancellation period jumps to 25 years. So the point of all of this is just so that you can see cancellation is there. It's been there. It just hasn't been happening. And so the Department of Education has implemented this IDR account adjustment to address some of the issues in the past with IDR not happening as it should have, and to fix the payment counting process going forward so that cancellation does come as it's supposed to and borrowers are credited for the time that they have had in repayment. Okay, so a bit more about the IDR account adjustment. This one-time revision only applies to borrowers who have direct loans and federally held FFELP loans. So if you have other types of loans, commercially held loans, you would need to consolidate them in order to get them into the pipeline for cancellation through this IDR adjustment opportunity. Now, the rules of what counts as a payment. Sometimes people are afraid of even entertaining consolidation because they look at their repayment history and say, oh, well, I was in forbearance, or, you know, I had a deferment, or I was late, I missed some payments. I just want you to see how lenient the rules are right now for what counts as a qualifying payment. So time towards IDR forgiveness includes, first, any months in which you had time in a repayment status, regardless of the payments made, loan type, or repayment plan. So if you missed a payment, if you were late on a payment, if your payment was short, if you were enrolled in the extended graduated plan instead of an income-driven repayment plan, that's okay. Time in default does not count. That's when you haven't made payments for at least 9 months, but other months, regardless of the payments made, loan type, or repayment plan, those months can count toward IDR forgiveness. Second of all, If you had 12 or more months of a consecutive forbearance or 36 or more months of a cumulative forbearance, those months can count toward both IDR and public service loan forgiveness. Third, any months that were spent in deferment, with the exception of an in-school deferment, any months spent in deferment prior to 2013 count toward IDR forgiveness. Fourth and finally, any time in repayment prior to consolidation on consolidated loans. This is a really important feature here because prior to this adjustment, prior to the limited PSLF waiver, if a person consolidated their loans, even if they've been in repayment for 20 years, the consolidation loan started out at payment number 1. The past payment history, it was not considered. The person would be starting fresh. And for that reason, a lot of people decided, you know what, I don't want to consolidate because I don't want the clock to start over again. So if you have a lengthy history and you consolidate, please know that that history will be considered for counting toward IDR forgiveness, okay? Now, just a couple of notes, well, a few notes for special populations. First, people that do not have direct loans or federally held loans. And I'm referring specifically to federal student loans. I know that's kind of confusing, but private loans are not included here. Loans that are truly private are loans that a bank or a credit union, some lender outside of the federal government is the actual lender. So we're talking about federal student loans here. If you have commercially managed federal student loans, those could be commercially held FFELP loans, Perkins loans, or health education assistance loans. Those loans would have to be consolidated to get on track for cancellation by way of IDR or public service loan forgiveness. You need to apply for consolidation by way of studentaid.gov by December 31st of 2023 to get the biggest benefit out of this one-time account adjustment. Also, people who are in default can benefit from the IDR adjustment, but you need to get out of default in order to benefit from it. And you can do that through what's called the Fresh Start Initiative. The Fresh Start Initiative is set to expire 1 year after the payment pause ends. So if you get out of default using the Fresh Start Initiative before that Fresh Start period ends, then you can benefit from the IDR account adjustment. Also, if you work or have worked for a qualifying public service loan forgiveness employer, all months of credit earned for the IDR adjustment can count toward public service loan forgiveness, provided that you complete the PSLF application that serves as documentation of your qualifying employment. So there are a lot of options here, but if you have commercially managed loans, you have that additional step to take of consolidating or applying to consolidate by December 31st, 2023 to get the biggest benefit. Okay, a bit more about consolidation. I want to again reiterate the difference between consolidating prior to this adjustment and prior to the limited waiver versus consolidation during the waiver period and during the IDR account adjustment. So in the past, borrowers might think about consolidating if they had lots of loans and multiple servicers. Consolidation would pay off all of those individual loans, and then the person could have all of their loans with one servicer. So one bill, one point of contact, instead of having to deal with multiple servicers at the same time. Also, if a person wanted to get on track for their future payments to count toward benefits like public service loan forgiveness or IDR cancellation. So in this example, you have a person who has two separate educational experiences. They have, let's say it's an undergrad group of loans that they've taken out. Those undergraduate loans have 162 months of repayment history. Then they went to graduate school, and the graduate school loans have 90 months of repayment history. If they consolidated before the waiver and the IDR adjustment, their direct consolidation loan would have 0 months of repayment history. That doesn't mean that they haven't made any payments. It just means that in terms of payments that would count toward public service loan forgiveness or cancellation by IDR, the clock was resetting at 0. So if they were pursuing public service loan forgiveness, they would be looking at least another 120 months of working for a qualifying employer while making payments on an income-driven repayment plan. Now, during the limited waiver and the IDR adjustment, credits that a person earns through the IDR adjustment can be applied to public service loan forgiveness if the borrower files a PSLF application that documents their qualifying employment. So in this same situation where a person has those undergrad loans with 162 months, the grad school loans with 90 months, consolidating through the waiver and the IDR account adjustment, those two loans are put together. The direct consolidation loan is now given credit for 162 months of repayment history. And if this person was pursuing public service loan forgiveness, they just need 120 qualifying payments. They have 162. So as long as they submit the paperwork to document their employment during those periods, then they would be approved for PSLF because they've exceeded that requirement of having 120 months of qualifying employment and 120 months of repayment history. So a couple of editions ago, we weren't 100% sure if consolidation during the IDR adjustment period would look exactly the same as it did during the limited PSLF waiver period that expired on October 31st. But now that information is put out there, the treatment of consolidation loans during the waiver will continue through the IDR adjustment until December 31st of 2023. So if you would like to get the greatest benefit from your repayment history prior to consolidation, please make sure that you apply to consolidate by December 31st, 2023, so that you can have, again, achieve the greatest benefit through this one-time opportunity that we're in right now, which is the IDR account adjustment. Okay, shifting gears a bit to PSLF and taxes. The question is, my biggest fear is being taxed for the forgiven loan. I moved from a state that taxes forgiven loans to a state that does not. Are loans forgiven taxed at the federal level? So glad this person brought up federal and state because they're two different types of taxes. The question is specifically about the federal level, and PSLF is not taxable at the federal level. I'm sharing the answer with you from Federal Student Aid's webpage. It says, question, are loan amounts forgiven under public service loan forgiveness considered taxable by the IRS? Answer is no. According to the IRS, student loan amounts forgiven under PSLF are not considered as income for tax purposes. And for more information, you can check with the IRS or a tax advisor. This is the link to that answer. This answer does not address the states. States might handle public service loan forgiveness and other types of loan forgiveness differently. So it's important to check with your state's Department of Taxation. You might be able to find a list out there that shows what states are currently taxing loan forgiveness, but at the federal level, PSLF discharged debt is not treated as taxable income. All right, next question. Is there any type of forgiveness possible if you have not made any payments and are back in school? So this question has a few layers. The question that I need an answer to in order to give an accurate answer is, have you entered repayment already? So is there any period in time that you actually entered repayment? Because it's possible that if you entered repayment before and didn't make any payments, you could still have some credit toward the IDR account adjustment. And if you work for a public service employer, that credit could be applied toward PSLF. So if yes, the question is, have you made any payments? And also, was your required payment $0? Because if a person hasn't made any payments, that doesn't mean that they were absolutely not in repayment. It could have meant that they just didn't make a payment. And during the IDR adjustment, some months when you did not make a payment could count as long as you didn't get into default. For a person whose required payment was $0, yes, that's possible. Through income-driven repayment plans, some people have, according to the formula, no disposable income. And if that's the case, the required student loan payment is $0. And even if they're not making any payments, the required payment is $0. Those periods can count toward cancellation by way of IDR as well as public service loan forgiveness if they've documented their employment. Next is, does your repayment status history include lengthy forbearances? So if you not made a payment, but you had a forbearance for 4 years, that forbearance could count toward both IDR and PSLF during the IDR adjustment. And just to share with you all some experiences from people I've dealt with, I've met with people who have had loans in forbearance for upwards of 10 years straight. And one of those people ended up having their debt forgiven by way of public service loan forgiveness. They had additional repayment history, but they also had a period of 11 straight years of their loans being in a forbearance. So if you haven't made any payments, you could have some credit out there that could be counted toward IDR and PSLF. But if you have never entered repayment at all, then the answer would be no, because the loans have to have been in repayment for the period to count toward IDR or PSLF. So if you just went from undergraduate school straight into graduate school and your loans have never been in repayment, then no, you would not have any credit toward the IDR adjustment or public service loan forgiveness if the loans never went into repayment. And just as a reminder, periods of in-school deferment do not qualify toward a payment count for loan cancellation by way of IDR or for PSLF. Also, I've had some people that I've worked with who said, I've never paid anything on it. And then we'll go in and we can see by looking at studentaid.gov, viewing their loan breakdown and looking at the loan detail on each loan, there's an option for you to review or view the repayment status history. And some people just don't remember that they actually made payments. It might have been a long time ago, but they actually have payment history in there. So I offer that experience to share with you that even if you can't recall making any payments, if you had loans that have been out there for a while, it's quite possible that you made a payment and you might not even remember it. So to take a look at that activity, you can go to studentaid.gov, look at your aid dashboard. When you click to view details, you'll go to a page that has your overall loan balance at the top, then loan types, and then loan breakdown. When you get to the breakdown section, this is where they'll list individual loans. Well, they'll list it by servicer. Then you can click on the servicer and it will show the individual loans. After you see the individual loans, then you can look at the individual loan details. And in the middle column of that section, you'll see view repayment status history. And when you click on that, or view loan status history, when you click on that, it will give you a timeline from when the loan was dispersed up until now. And it will show you the status history of the loans. It could be forbearances, grace period, in-school deferment, default, bankruptcy, whatever it is, you'll be able to see if the loan was ever considered as in repayment. And that's helpful to know if you'd like to know if there's any credit that you could have applied toward IDR cancellation or public service loan forgiveness. So take a look there at studentaid.gov. All right, next question. Do I get additional counts towards my 120 if I qualify for IDR forgiveness, even during the same period as the COVID relief? If the IDR puts me over the 120, do I qualify for a refund? If all loans did not consolidate for PSLF, will IDR cover all? All right, that is a loaded question. So I want to just break this down into bits. The first one has to do with the COVID relief. I'm assuming that this refers to the CARES Act forbearance that went into effect in March of 2020. So since then, most federal student loan borrowers have not had to make a payment and have not had interest accrue. Months during this CARES Act forbearance count toward the IDR account adjustment. The second thing has to do with public service loan forgiveness. Time credited toward the IDR account adjustment can be credited toward public service loan forgiveness. To make sure that it's credited toward public service loan forgiveness, you need to submit the PSLF application for every qualifying employer you worked for after October 1st of 2007. They're going to look at your employment history, they're going to look at your repayment history, and they're going to look for 120 months of overlap. You might not be at 120 yet, but you need to fill out the PSLF application to get a count to find out where you are. As far as refunds are concerned, refunds can be issued if you made more than 120 qualifying payments on a direct loan. if you had FFELP loans for, let's say, 18 years, and you consolidated very recently to get your loans considered for public service loan forgiveness, technically, your consolidation loan would have come into the direct loan program and been a part of the CARES Act forbearance. So you haven't had to make any payments since the direct loan originated. If they come back and say, all right, you have a count of 175 qualifying payments. Yes, that's over 120, but the payments were made when the loan was a FFELP loan. So you would not get a refund for extra payments that were made on a FFELP loan. But if you had consolidated, say, 5 years ago into the direct loan program, and they came back and said you got 155 payments, they'd have to look at the point at which you crossed beyond 120 and whether your loan was still a FFELP loan or a direct loan. If the loan was a direct loan, when you made a payment beyond 120, then you should get a refund. But if you crossed over 120 while the loan was a FFELP loan, you would not get any refunds of the loans, of the payments that were made when the loan was a FFELP loan. So complicated way of saying that refunds only apply to direct loans, not FFELP loans. All right. And there was one more piece of this question. It said, if all loans did not consolidate for PSLF, will IDR cover all? I wasn't 100% sure what this meant, but I just tried to break it down into pieces that hopefully answer the question. The first one is, the public service loan forgiveness covers direct loans only. So if you want those loans all of your loans to be considered for public service loan forgiveness, and they were not already direct loans, you would have to consolidate them into the direct loan program to get them on track for PSLF. But if you did not consolidate all of your loans, let's say you did half and half, the half that are direct loans would be considered for public service loan forgiveness once you submit the PSLF application to document your employment. The other loans would not be considered because if they are non-direct loans, they don't qualify for public service loan forgiveness. So for the rest of those loans, the IDR adjustment could cover them if they are another kind of federally held loan. So key thing to remember here is that the IDR account adjustment covers direct loans and federally held loans. If your loans are commercially managed, that could be commercially held FFELP loans, Perkins loans, HEAL loans, anything that's not direct or federally held, then you would need to apply for consolidation by December 31st of this year to get the greatest benefit from the IDR adjustment. So some people did consolidate some of their loans and leave another portion outside of the consolidation. IDR could cover them all as long as they're federally held or direct. If they're commercially managed, then you have that extra step to take to get them in the pipeline for cancellation by IDR and possibly PSLF. So this often comes back to the questions, well, how do I know, what kinds of loans I have? If you have loans that were included in the payment pause, when the payment pause started back in March of 2020, then you have federally held loans or direct loans. But even at a higher level, sometimes people aren't sure whether their loans are federal or private. So the first thing, if you want to know what your loan types are, the first thing you should do is log into studentaid.gov. Any loans that you see with a balance inside of studentaid.gov are federal student loans. If they're private student loans, they would not be seen inside of studentaid.gov. If they're private loans, you would have to go to the lender in order to see those loans, or pull your credit report where you could see your federal loans and your private loans. But anything inside of studentaid.gov is a federal student loan. Now, once you've established you have federal loans, you need to see what type of federal student loans you have. And the distinguishing characteristic here is, are the loans held by the Department of Education, or are these loans commercially managed? If they're held by the Department of Education, you might hear them referred to as federally held or ed held. And here's how to verify. First, of course, you want to log into studentaid.gov. On the dashboard, you can click View Servicer Details. If your loans are held by the Department of Education, you'll see Department of Ed / and then the name of the servicer. Or if the loans are in default, you'll see Default Management Collection System. As an example, if your servicer is Nelnet and your loans are federally held, you'll see Department of Ed/Nelnet. If your loans are not federally held, you're likely to see the name of perhaps a bank or another company there. That means your loans are commercially managed. And if you want to get them considered for IDR cancellation or for public service loan forgiveness, you need to consolidate them into the direct loan program through studentaid.gov. All right, next question. This is also PSLF. Worked 10 consecutive years in higher education in the past between multiple colleges. Will I be able to use these years of service working for a nonprofit, which is a public school, to meet my criteria for loan forgiveness? So the essence of this question is, can I change jobs and still be eligible for public service loan forgiveness? And the answer is yes. Public service loan forgiveness does not require consecutive employment with the same organization or even consecutive employment at all. It's true that you can achieve public service loan forgiveness faster if your employment is consecutive, but it's not a requirement. The only thing that would happen is if you switch jobs, any time that you're not working for a qualifying employer would not count toward public service loan forgiveness. Once you start to work for another qualifying employer, you send in another PSLF application to document that employment, and the clock would pick up where you left off with your last employer. So just some tips to get on track with PSLF and to stay on track. To get on track, you have to submit a PSLF application to document your employment. Some people say, well, send it in once you start working for a qualifying employer. Other people will say, well, send it in after you've been there for a year. I'm kind of on the side of send it in once you begin, because if you send it in once you begin, the servicer is MOHELA. MOHELA is going to evaluate whether your employer qualifies. If your employer qualifies, then they'll initiate the transfer to pull your loans from your existing servicer over to MOHELA. And I think it makes things easier if that transfer part happens as early on as possible. So to get on track, it's not required, but I'm suggesting you submit a PSLF application when you begin working for a qualifying employer. To stay on track for PSLF, there are several times where you'll need to submit another PSLF application. Because if you've done this before, you know the PSLF application, it's just a job verification. But you have to send it in repeatedly for MOHELA to update your number of qualifying payments. So I recommend that you submit another PSLF application once every 12 months. If you leave a qualifying employer, I suggest you complete another application when you're leaving so that you can get every possible month credited up until the end. And then when you start working for another qualifying employer, submit another PSLF application so that you can begin the clock ticking with that employer. The last time you should submit a PSLF application is the month that is your 120th qualifying payment. Now, if you are just starting your PSLF journey today, you cannot really tell when your 120th qualifying payment will be achieved. You can estimate, but if there are periods where you're out of work or you work in the for-profit sector or you have, just gaps in employment between qualifying organizations, that's going to push out the 120, further and further with each gap. So as you get closer to it, and as you submit those forms, every 12 months or when you change jobs, you'll see your qualifying payment count increase with MOHELA. And as you get closer and closer to the end, you'll be able to project, okay, I will make my 120th qualifying payment in November of 2025. So you want to make sure that in November of 2025, and I've heard some people say wait until after the middle of the month, but in November of 2025, you definitely want to make sure that you file that PSLF application so that you can have your payment count updated to reflect that you have made your 120th payment and have the remaining balance canceled by way of PSLF. So it's not just a one-time thing. You need to make sure that you complete those PSLF applications periodically so that your account updates. And if you have not done this, periodically, don't worry. It doesn't mean that you can't qualify. All it means is that you now have more history that you have to go back and document. And sometimes that can be hard, especially if the organization is no longer open. So it just makes it easier if you're submitting the applications as you work and repay, instead of waiting until you get to what you think is 120 and then going back and trying to document your past employment and playing catch up, okay? All right, next question, also PSLF. What if you have applied for the recent student loan forgiveness and you meet all the qualifications except the consecutive payment schedule due to being in school? Is there a way to contest that you meet all other requirements? So I figured that this question was about PSLF because it, talks about all the qualifications and it mentions consecutive payments. And the consecutive part is a common misconception about public service loan forgiveness. Your payments don't have to be consecutive. It's true that you can achieve PSLF faster if your payments and your work experience are consecutive, but it's not required. So I just wanted to take a moment to review the rules of PSLF Basic, as they call it, the original program rules. And we'll skip over TEPSLF and just zoom in on what PSLF looks like under the IDR account adjustment. So standard rules of public service loan forgiveness are that 1, you have to make 120 monthly payments. 2, the payments can only be made on direct loans. 3, the payments have to have been made while you were enrolled in a qualifying repayment plan. 4th, the payments have to have been made while you were working full-time directly for a qualifying employer, or you could have multiple part-time jobs all for qualifying employers that when combined equate to full-time employment. 5th and finally, you still have to be working for a qualifying employer at the time that you apply for PSLF and the time that you receive it. Now, if we look over to the IDR adjustment period, first thing you'll notice is different. Instead of 120 monthly payments, it says 120 periods of repayment. So it doesn't matter if a payment was missed. It doesn't matter if the payment was short, if the payment was late. That part, it does not matter during the IDR adjustment. They're looking at the status of the loan. Was it in repayment? Was it in certain types of deferments? Was it in certain types of forbearances? All of those things can count under certain circumstances. So it's not just about the months where you actually made a payment. Notice the requirement that the history had to be with direct loans. That's temporarily stricken. The requirement that you had to have paid under certain types of repayment plans, also stricken. What remains is that you still have to document this full-time employment directly for a qualifying employer or qualifying employers if you have more than one part-time job. 5th and finally, you still have to be working in public service at the time that you apply for and receive public service loan forgiveness. Now, the limited waiver period was a little bit different in that 5th requirement that you still had to be working in public service, that was eliminated. So that provided the opportunity for retirees or for people who had switched from, public service careers over to for-profit jobs. If they already had the 120 periods of repayment and 120 months of overlapping work experience, they could have gotten public service loan forgiveness. And I know several people who have achieved that. But that piece of the waiver did not carry forward into the IDR adjustment. So you still need to be working in public service at the time that you apply for and receive public service loan forgiveness. All right, now about the consecutive part. PSLF does not require consecutive payments. It works faster that way, but it's not a requirement. Also, time spent when you're in an in-school deferment will not count toward PSLF because technically the loans were not in a repayment status. They were on pause due to the fact that you were in school, enrolled at least half time. So there are some options. There is an option to opt out of the in-school deferment and continue to make payments. And that could make sense for you if you're continuing to work full-time for a qualifying employer while you are in school. But you have to be mindful that if you're borrowing for the graduate experience, those loans are going to be on the in-school deferment. And those particular loans are not going to earn credit toward PSLF while they remain in an in-school deferment. Your loans from your undergraduate experience that you have opted out of the in-school deferment for, you can keep making payments on those toward public service loan forgiveness, but those loans will be separate from the current loans that you're taking out if you're in school right now. Now, depending on when you're due to finish school, if you're graduating this May and you have, grad school loans and undergraduate loans, you might consider consolidating those to get the maximum amount of credit through the IDR adjustment period. But that's a very personal decision. You need to take a look, at your loan portfolio and see if consolidation would make sense for you. But there are options, but you can't get around that time in an in-school deferment not counting toward PSLF. It just doesn't count, okay? All right, we had a lot of questions tonight, okay? Next is, I've consolidated my student loans, enrolled in PSLF, and I have approximately 19 payments to go before forgiveness. However, is it wise to continue to make payments while the loans are on pause due to the lawsuits? So first, I have to say congratulations that you only have 19 payments to go because you got more in front of you than more behind you than you do in front of you. But this question is loaded and we need to break this into separate pieces. So there are three issues that I pulled from this question. One is the PSLF application, one is the CARES Act forbearance, and the other is the lawsuit blocking broad cancellation. These are three completely different issues. Public service loan forgiveness is a federal law. So if you've applied for public service loan forgiveness, that has nothing to do with the lawsuit that's blocking that broader cancellation plan. So public service loan forgiveness, just think of that as its own path. The CARES Act forbearance is also something that is a separate issue. That began in March of 2020 and made it so that most federal student loan borrowers were not required to make a payment and had no interest accruing. The third issue here is lawsuits. The lawsuits have nothing to do with, public service loan forgiveness. The lawsuits that are with the Supreme Court right now are about broad cancellation. That's the program that would provide up to $20,000 of debt relief for eligible federal student loan borrowers. The lawsuits have no bearing on public service loan forgiveness. Just want to make sure that that's crystal clear. These are separate debt relief initiatives. Now, when it comes to the CARES Act forbearance, if you have documented qualifying employment throughout the CARES Act forbearance, then the months of the forbearance will count toward public service loan forgiveness. So whether you make a payment or not, the months are going to count. So the question was, is it wise to keep making payments? It's not necessary. If you really want to make payments, then you can. But if you're pursuing public service loan forgiveness, there's no need to make a payment. If it turns out that you have made payments and you paid beyond the 120, you would get a refund. But since the months will count whether you make a payment or not, I lean on the side of why bother. If you have the qualifying employment, your loans are part of the pause, then these past 3 years will count toward public service loan forgiveness as long as you submitted that PSLF application to document your qualifying employment throughout that period. So bottom line, months during the pause are going to count anyway, as long as you document your employment. So there's no incentive to make a payment, although you're free to make a payment if you'd like to. All right, next question. I applied for my student loan forgiveness and yet to hear about my application. What should I do? Right, so I wasn't sure with this question which forgiveness program the person was referring to. So I just wanted to approach this question from the lens of the different plans that are out there right now. So first we have that broad relief plan of the Biden-Harris plan, which provides up to $20,000 per borrower if it's allowed to move forward. We have the IDR account adjustment, which is where a person can have up to their entire remaining balance canceled. And then public service loan forgiveness, which is also about the entire remaining balance. So for the Biden-Harris plan, there was an online application that became available in October of last year, but the application was pulled down after several lawsuits. So right now that application is not available pending the outcome of the Supreme Court, whatever decision they decide to make. But if you did complete that application soon after it came out, you probably received an an email that confirmed that you completed the application and told you if you were deemed eligible or not. When it comes to the IDR adjustment, there is no application for it, but you have to have direct loans or federally held loans to be automatically given a payment count. So if you have commercially managed loans, there's still no application, but you would not be considered for the IDR adjustment unless you consolidated those commercially held loans into the direct loan program, and you make sure that you complete that application to consolidate by December 31st of 2023. As for when you'll hear something, according to the Department of Education, that IDR adjustment is supposed to be implemented in 2024. So if you have a direct loan or a federally held loan, and you've taken those commercially managed loans and consolidated them by December 31st, or at least apply to consolidate them by then, you should hear something in 2024. As the year gets nearer, I'm sure we'll hear more information about the exact timeline. As for public service loan forgiveness, the application is available online at studentaid.gov/PSLF. There's an online version of the application that you can complete via the PSLF help tool. I highly recommend that you use the help tool instead of just downloading the blank PDF and trying to write it in, because if you check a box, it's possible your application could get rejected and you might have to do it again. So save yourself the trouble, use the PSLF help tool if at all possible. As for when you'll hear something back about your PSLF application, that depends on whether your employment qualifies. If your employment qualifies and MOHELA is not your servicer, they will pull or submit your servicer will submit a transfer request to MOHELA, and MOHELA will then take over being the servicer for your loans. They usually let you know before that transfer takes place, but the amount of time it takes could vary. If your employer does not qualify, then they'll send you a note to say you don't qualify, and they will not transfer your loans over to MOHELA. From there, it usually takes people about 3 to 4 months to receive a qualifying payment count. And just as a warning, the first payment count you see, if you recently consolidated, the payment count's going to look very low. It's going to look like a rejection. But usually in a few weeks, another count comes that considers the repayment history prior to consolidation, and that payment count should be more accurate. But once you know MOHELA is your servicer, I encourage you to set up an online account as soon as possible and take a look at that PSLF menu and see if the payment tracker is available to you. If you can get into that payment tracker, you can see month by month where they have certified your employment and which periods are eligible, but just waiting for certified employment. But to get an accurate qualifying payment count, it usually takes about 3 to 4 months after an application that has an employer that qualifies. Okay, so patience is key. All right, so that does it for the questions. I just want to wrap things up by sharing some options for accountability, because many times people want to know, how can I file a complaint, or how can I get some movement? I'm having trouble dealing directly with the servicer. So the few options you have. First is you can go to the Consumer Financial Protection Bureau at consumerfinance.gov. You can also visit the U.S. Department of Education Ombudsman's Office, and you can see which types of issues they deal with. And if you have an issue related to public service loan forgiveness and you don't agree with your count, you can go ahead and file a PSLF reconsideration request. As for the state of Maryland specifically, we do have a student loan ombudsman that's here to help borrowers with issues they might be having with their student loan servicers. The list of issues include failure by the servicer to communicate with a borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidations or modification errors, and/or inappropriate collection activity or tactics. You can reach out to the Ombudsman for the state of Maryland online through the Department of Labor. If you have tried to go through your servicer and the issue just seems like it's not being resolved, I strongly encourage you to file a complaint with Maryland Student Loan Ombudsman, and perhaps in partnership, you can push this toward a resolution. In the state of Maryland, borrowers also have a Bill of Rights, and you can find that online through the Department of Labor as well. That will give you specific information about the protections to which Maryland borrowers are entitled and the obligations of their student loan servicers. All right, so we are right at the 8 o'clock mark. Thank you so much for joining me for this, the April 26th edition of Office Hours. As always, if you have any questions between this edition and the next one, please do visit us online at mccfw.org. There's a contact form there. You can submit your questions. You can also subscribe to our mailing list, or if you'd like to support the cause financially, you can donate. You can also reach out to us online through social media. We are at the MCCFW on Twitter and Instagram, and we are the Maryland Center for Collegiate Financial Wellness on Facebook.